A very good evening, everyone. I see Abhilasha Mudgal, and I am very delighted to welcome you all in today's webinar on pharma sector, which is organized by Committee for Members in Industry and Business of the Institute of Chartered Accountants of India. I welcome C. Durgesh Kumar Kabra, sir, Chairman of CMINB of ICAI, our Speaker of Session, C. Nitin Khatri, sir. We have also our speaker, C. Nitin D. Parekh, sir, and our Vice Chairman of CMINB of ICAI, C. Rohit Rubatia, sir, who will join us later. By extending this session, I request to see Durgesh Kumar Kabra, sir, for deleting the welcome address for the session. Please, sir.
Thank you, Abhilasha. It's indeed a pleasure for me to be a part of this webinar series which we have started onwards. Earlier, the members in industry committee for members in industry and business were not into the various kind of these kind of activities, and we were not having these kind of webinar. But this year we thought of that we must build the skill set of our members who are into the various industries, that what are the issues in audit, what are the issues in accounting, what are the issues in taxation, what are the issues in risk and advisory, etc., with respect to a particular industry. And we thought of we must have a series of these kind of webinars. We started with real estate. This is our second webinar on pharma sector. And lined up one is the capital market and banking sector. We would be doing on those very soon. Friends, let me tell you that the Committee for Members in Industry and Business is doing a lot of activities for all of you for the whole year. The more important activities are three are very important of this. One is 40 under 40 award, where we recognize the 40 young business leaders who are under the age of 40, which is going to be announced in this week, where young chartered accountants who have done exceedingly well into their organization can take part into it and can get recognized by the alma mater ICAI. We do have the CEO and CFO award, which is known as ICAI award, where the business leaders who are the chartered accountants, the CFOs who are the chartered accountants, are being recognized by the ICAI. And this we are going to have in the month of January, and would request all of you that you know anybody who is the CEO, CFO of the any enterprise, and he is entrepreneur himself, which is in the size conglomerate or so, can definitely recommend him to file the nominations for that person. And we would be recognizing them also for this award, which is one prestigious award which is being given by the alma mater ICAI. And the third is ICI, the Chartered Accountants, the Growth Gear, which is another initiative started 2 years back when I was the vice chairman of this committee, where we are having the interview with the non-chartered accountants who are either CEO, or entrepreneur, or the leader of that organization, who is the key person for development of that organization. We are having the interview with him, how that chartered accountancy has helped him or her to reach to the pinnacle of the positions where they are today. And the same is being telecasted on the G Business channel on alternate Sunday at 11:22 a.m. I think these are the three things which I thought I must tell you, and all the chartered accountants either be part of viewing and attending this, or be part by making them recognized and nominating to these awards as well as to these kind of shows. We do have the regular CFO meet at various locations across the country, where roundtable kind of things have been designed for the CFO meet, where the CFOs are gathering together. They are discussing the issues of the industry. They are discussing the other issues with respect to compliance in the finance sector, as well as how we can help them out with the various other things where the Chartered Accountant Institute should help them out. So we are having the CFO meet also. We do have the career action program for the senior chartered accountant. We have twice in a year the program known as the campus placement program for newly qualified chartered accountant. The 58th version of the campus placement program is going on, where around 100 plus company have 123 company have already registered, and in the second phase of this, we expect lot many other companies where we will not be charging a single penny from them. In the first phase of this interview, we do charge for taking the participation into the campus placement program. So this is one major event which is being done for young chartered accountants, and we also have the orientations program for them where we guide them what they should take care when they are appearing for the group discussions and interview. We do have mock interview, we do have psychometric tests, we do have management development programs, and these kind of orientation to choose the right friends. Besides this, we uh, regularly do hopeful that we remain connected with all of you, and you all remain connected with the ICAI. We are trying to have started working at the portal will be members who are looking any activity which is related to them would find over there, and probably if they suggest something else is to be done for the benefit of the members, we can do this. Coming back to today's webinar, let me tell you that today's webinar on pharma sector from a chartered accountant's perspective will provide all the listeners who have attended this with a valuable insight into the financial and regulatory aspect of the industry. We have two speakers today. First, Mr. Nitin Khatri, who is from Mumbai, and another one is also Mr. Nitin Parekh. He is also Nitin, and he is CFO of Zydus. And both are chartered accountant. The first one, Nitin Khatri, would be dealing with the audit and accounts, issues in audit and accounts, auditors and auditee perspective. What are the challenges over there which are required to be taken care of, and how we can overcome all those challenges, if it is even from the auditee's perspective or this the auditor's perspective. Then Mr. Nitin Parekh would be dealing with the challenges which are there with respect to the risk advisory in pharma sector, and how to manage the risk at large in the pharma sector. Because pharma sector is again a technology sector where the technology is fast and every time you have to do something different, and how the things are to be taken care of. Those things will be led by Nitin Parekh. There is a great importance of the accurate financial reporting and adherence to the accounting standards within the pharma sectors, which will be taken care of by Nitin Khatri. Today, the pharma company faces specific financial challenges such as revenue recognitions for milestone payments and collaboration arrangements. There is a great importance of managing tax liabilities and transfer pricing in global pharma business. The risk assessment and mitigation strategies too. So all these are to be taken care by these two Nitins who are with us, and they would be telling something new about the various kind of these issues into the pharma sector. Chartered accountants, we also play a pivotal role in evaluating financial risks and opportunities in M&A deals and transactions in the pharma sectors too. In today's scenario, there is increasing importance of sustainability reporting and environmental, social, and governance disclosure in the pharma industry too, where chartered accountants can contribute to ESG reporting and aligning financial performance with the sustainability goal. Institute of Chartered Accountant of India has taken a big initiative and set up a standard, the board, which is known as Sustainability Reporting Standard Board. And we also have framed the sustainability standards in association with the, and we are also today now on the board of International Sustainability Standard Board, where Preeti Savla is representing India. And I feel proud that when this board was established in India by ICAI, I had been the vice chair of this sustainability reporting standard board for first 2 years consecutively, and my chairman was Mr. Sanjeev Singhal. Friends, today the ESG is becoming very important, and the chartered accountants, by passing the certificate course in the sustainability reporting standard boards organized by the sustainability reporting standard boards, I think can enter into a different arena of service where, as we see that we are the complete business solution provider, as we are known that we are partnering in nation building, so we can walk into a different line of activities by providing the services of ESG reporting also. With this, I thank you all for giving me a patient listening, and I'm sure that today's discussion will be very useful to all the participants. Thank you all.
Thank you so much, sir, for your words and wisdom and awaiting us about opportunities related to Committee for Members in Industry and Business. So now I am profoundly delighted to take an opportunity to introduce the speaker of session, C. Nitin Khatri, sir, who will guide us about the statutory audit and challenges in the pharma industry. Sir is a partner in Price Waterhouse Chartered Accountant LLP and having experience of more than 22 years. He has provided assurance services to large multinationals and listed entities. Sir has extensive experience of audits under Indian GAAP, Ind AS, IFRS, and international standards on auditing. Assisted organization in process design and implementation of internal control. Sir has also experience of leading domestic and international capital market transactions for his clients. He also help and motivate young minds in their growth journey. Sir, I requested you to please light up the session by your compendious knowledge. Please, sir.
Yeah, thank you so much, Durgeshi, for setting the context, and thank you, Abhilasha, for that kind introduction. Am I audible and visible?
Yes, sir.
Okay.
You are audible but not visible.
But not visible.
Sir, visible.
Visible, but I don't know. On my screen is not visible. So
No problem.
fine. Thank you. Great.
And I'm very thankful to the committee for inviting me to share my perspective on the statutory audit of companies in pharma sector. What I have done is I have prepared a short presentation, which I will share it with you all. Is my presentation visible?
Yes, sir.
Yes,
Yes, sir.
it is visible.
Yes, sir.
Yes, okay. So my presentation is divided into three parts. First one is the general overview of pharma sector in India. The second part is about the key challenges and issues that we face in audit of the pharma companies. And third one is about the key accounting and auditing matters that specifically relates to the pharma sector. So starting with the overview of pharma sector, friends, I'm sure you would have heard this statement many times that India is the pharmacy of the world. And this was in fact the statement made by our honorable finance minister in the last budget session. And this is also evident from the fact given below, which is the current size of industry is almost USD $50 billion, and it is estimated to touch $130 billion by end of 2030. And in terms of the India produces around 60% of the global vaccines around the world, and India has the second highest number of US FDA approved plants outside of India, and it is almost more than 700 or even more as of now. and the contribution of pharma sector in the country's GDP is almost like 2%, and it is expected to grow by at the CAGR of 10.7% in next 5 years. And India is like world's third largest production by volume and 14th largest by value. And this list is actually, it can go on and on, but in short, pharma sector is very important for our economy, and in terms of both revenue and in terms of providing employment opportunities. So it is only important that we also focus as members of institute on the pharma sector and be equipped with the industry specific issues, and like it is one of the sector that we focus on. So, and in fact, government is on the mission to boost this sector further. And in order to do that, there are a lot of government initiatives and schemes which have been launched in recent past. And like most important being the PLI scheme for promotion of domestic manufacturing. So I'm sure like we will come across these schemes and related accounting in our clients. So it is important that we familiarize ourselves with the terms and conditions of these schemes. So I won't go into details of these schemes today. Yeah. Coming to the main part of my presentation, which is the statutory audit of pharma companies. And I will be actually, I will use based on my experience of so many years and especially of pharma companies, I have highlighted these few areas which I think are the areas of focus or challenges that we face in the audit of pharma companies. The first and foremost is, the pharma sector is highly regulated in India, and according to me, like it is the most regulated sector after the financial services. And why this is relevant for us? And like, it is important because there is an auditing standard 250, which requires us to consider the laws and regulations in an audit of financial statements. So it is, it is very important that we understand the regulatory framework in which our clients operate, and this is only possible by doing a lot of reading and familiarizing ourselves with the applicable laws and regulations. In fact, this particular seminar, which is on the pharma sector, is one of the best way to familiarize ourselves with the nuances of the pharma companies. So likewise, if there are other sectors like real estate and other sectors, these are the ways how members can familiarize themselves with the relevant laws and regulations for their clients. So this auditing standard actually lays down the specific roles and responsibilities of management, and more importantly, responsibilities of auditors in the audit of financial statements, specifically relating to laws and regulations. And it starts with the understanding of laws and regulations. And second, the very basic thing is to stay alert when we are doing audit, because we may come across some expenditure, or there are some like payments to the legal firm which indicates us certain litigations or laws and regulations. So we have to stay alert. We have to make inquiries with those charged with governance, which may include the audit committees and board of directors of the company. And we have to take written representations about the laws and regulations from the companies. But remember one thing, that finally the determination of whether there is compliance or non-compliance is a legal matter. So we have to also consider the views of legal experts, and like of course we have to apply our reasonable judgment, but it will be determined by the lawyers whether there is a non-compliance or not. So, like, this is one area where actually we spend a lot of time in doing audit of pharma companies. Second, the most important area is revenue recognition, because pharma sector is highly competitive, and revenue is one of the key performance indicator for the pharma companies, and also one of the uh, area which is linked to the incentives of management. So in order to to be in the top company by revenue, there is a lot of pressure on companies, and even the auditing standard 240 says that it is always presumed that the company, there will be risk of fraud in revenue recognition, wherein company may understate or overstate the revenue. And like it is, for pharma company, it is very unlikely that we will be able to rebut this presumption that there is no risk of fraud in revenue recognition. So it is very important that we understand this risk. We design the audit approach which is robust enough to mitigate this risk to an acceptable level at the planning stage of audit, and by performing the robust audit during the all phases of audit. The third point is also related to revenue recognition, and there are specific complexities in revenue recognition, especially in India. The number of customers, which in most cases are distributors, could range between 4,000 to like 6,000 distributors. This is very different from the other countries where the customers and distributors are in like single digit. Well, I have this experience in one of my pharma client where in like other territories the distributors were not even five or six, and in India it had 4,000 to 5,000 distributors. So this makes the revenue recognition very complex, and there are multiple geographies within India and outside India, and with every customer there could be different terms of sales, and there could be right to return, price adjustments, etc. And the company may have different terms, like somewhere they have CIF, somewhere they may have FOB. So it is very important that we understand the terms of business. We evaluate the appropriateness of the accounting policy followed by the company for the revenue recognition disclosures which are being made by the company in the financial statements with respect to revenue. And again, like I said earlier, the audit approach is designed to ensure that the risk of misstatement is minimized. So the next point is about the uncertain tax positions and other litigation. This is also a very important area in the pharma companies. There are a lot of old and like tax litigations which are ongoing, which are industry related litigations, and there are a lot of litigations around the pricing of drugs and the unethical practices followed by the companies, and the demands raised by the regulators are really significant compared to the size of company. So the probability assessment as per India 37 is very critical. What is the probability of the outflow, which is done by the company, and sometimes they have to take the help of experts, which could be legal expert in this case. And so as an auditor, we are required to challenge this probability. We can't take it on the face value of management. So depending on the probability, either it could be a provision which company is required to make, or it could be a contingent liability which needs to be disclosed in the balance sheet. So this is another area where the auditors spend a lot of time in audit of pharma companies. And based on my experience, there are a lot of significant accounting judgments and estimates which are involved in the preparation of financial statement. This is true for all companies, but for pharma company, this is more important. And lease is one area where a lot of judgments are involved: refund liabilities, refund assets, provision for rebates and returns, inventory adjustments, research and development costs, what needs to be capitalized and what cannot be capitalized, at what point in time it can be capitalized. So these are all judgments, and we have the auditing standard 540, which requires us to challenge these judgments and perform certain specific procedures as auditors in order to be comfortable. So this is one area where we spend a lot of time to meet the requirements of, let's say, 540. The next important point is around the impairment of intangibles, which mainly includes the IPRs. So, because IPR is one of the key item in the balance sheet of any pharma company, and this is very vulnerable because of variety of reasons, because of the competition. Like there could be a new drug which is in the market, and there are a few other reasons because of which it is very vulnerable. So it is very important that we do this assessment at each balance sheet date if there are any triggers for the impairment, and we test the impairment done by the management. So, and the last one, which is again very critical, considering the reporting requirements we have. I have seen that the pharma companies encounter the most whistleblower complaints, and like sometimes it could be even more than 100 in a year. It is very industry specific issue, I would say, and a lot of times these whistleblower complaints may have impact on the financial statement, and sometimes they are very operational. And it is very common, like the management representatives will complain about another management representative, about some unethical practices followed by the company. So as an auditor, what we are required to do is, first of all, we are required to obtain the full list of all whistleblower complaints received by the company. Then we have to evaluate along with company and the committee which is formed by the company for to investigate these complaints, whether these complaints have been addressed properly or not, whether this has any impact on the financial statements of the company and our report. Because remember that in Caro report, we are required to make this statement specifically that we have considered the impact of all whistleblower complaints received by the company. And we are also required to comment on the material frauds by or against the employees. And the most important thing is about the reporting under 143.12 to the central government. So if based on the whistleblower complaint, we have any indication that there could be a fraud or alleged fraud by or against the company, then the auditor is required to also evaluate whether this requires any reporting to the central government under section 143.12. So these are some of the key areas of focus or challenges that we generally encounter in audit of pharma companies, and that is why you will find most of these or some of these in the key audit matters which the auditors would have reported in the audit of listed companies for listed pharma companies. I would really urge if members can go through the areas of focus or the key audit matters of top pharma companies. That would give you a very good overview of what are the challenges faced by the pharma companies, exactly what is the issue, why it was considered as the key audit matter, what was the audit approach designed by the auditor to address that key audit matter, how it was concluded. It's a very good insight if one has to go through the audit of pharma companies. So I really recommend the members to go through key audit matters. And in the next slide, I've just prepared the summary of the legal and regulatory landscape applicable to a pharma company, because the most important area of focus was that it is a highly regulated sector in India. So I thought it will be important to give this summary of the regulatory landscape. So you will see that there are five broad domains about the manufacturing, about the pricing, marketing laws, patents and trademarks, and competition. And all of these domains are governed by different regulators, like in it is DGCI and PPA, Department of Pharmaceutical and Competition Commission of India. And this is only the illustrative list. It could be even more, but these are some of the important regulations which auditors should be really familiar with, because we are expected to be familiar with the laws and regulations applicable to our clients. So with this, I will move on to the next phase of my presentation, which is about the key accounting and auditing issues in case of pharma sector. So what I've done is I have actually created some scenarios uh, on a hypothetical basis, and along with the question arising out of the scenario and what is the suggested answer. There are around 10 to 12 such scenarios which I will discuss, and then I will open it up for the Q&A at the end of this section. So this is about the contract manufacturing arrangements, which is very common and critical in case of any pharma company. And after 116, India's 116 came into picture, this was one of the most impacted area. So determination of the embedded lease in the contract manufacturing arrangement. So the scenario is the customer A enters into an arrangement with the contract manufacturing operator to produce medical equipment and disposables, which the customer A will sell to the outside customers. The CMO has multiple production lines that it uses to fulfill orders for multiple customers. The arrangement allows the CMO to choose the production line used to fulfill customer orders, and even after the production of the product commences on a product line, CMO can easily change to a different product line with minimal transfer cost because other production lines are available. Customer A submits legally binding purchase orders quarterly to the CMO, and it contractually required to provide an annual non-binding production forecast. The products are generic and can easily be stored, and the CMO has full discretion over the operating process, including the selection of material to use in production. So the question is whether this arrangement contains a lease. because that will decide the whole accounting of this arrangement after India's 116 was introduced. So, the general rule under 116 to evaluate such situations is that whether that arrangement contains a lease if there is an explicitly or implicitly identified asset in the contract. Asset in this case would mean the plant and machinery or the product line. And the second condition is the customer controls the identified asset over the period of use. So it is and both the conditions have to be satisfied. There should be an identified asset, and the customer should be able to control the identified asset, which means the customer should be able to decide whether which production line is to be used and how it is to be used, when it is to be used, what is the process. So in this particular scenario, based on the facts, the arrangement is not likely to contain a lease under India's 116, while the use of asset is implicit in this case, but it is likely no identified asset because the substantive substitution right exists. And the fact also said that it can be substituted at a very minimal transfer cost. If the cost would have been so significant that it is practically impossible to shift, then the answer would have been different in this scenario. So even if there was no substantive substitution, there is likely not a lease because the CMO has a right to change the operating process and decide when the output is to be produced. So we have to test on these two criteria whether there is an underlying asset and whether it can be controlled by the company. So the if we move on to the second scenario, so assuming the same facts which we discussed in the first scenario, the only difference is that there is a dedicated production line for the product. The contract manufacturer is contractually unable to use any other production line. The products are highly specialized and purchase orders are very frequent and effectively determine whether, when, and how much output is produced. In addition, key operating decisions are standardized and are subject to approval by customer A. So you see the difference between scenario one and scenario two. Here, like there is no dedicated line. There is a dedicated line over here, and the decisions are taken by the customer. So the question is whether this arrangement contains a lease. So the guidance is that this arrangement is likely to contain a lease under India's 116. An identified asset is explicit in the contract because as per the contract, there is a dedicated production line which the CMO is required to use and he can't change at his own discretion. It is only the company who can decide which production line is to be used. And there are no substitution rights as per the contract. There is a dedicated production line, and customer A appears to effectively control the decision making rights over the use of production line because customer A's purchase orders effectively determine whether, when, and how much output is produced by the dedicated production line. So all the indicators are suggesting that there is a lease, and the both the conditions given in India's 116 are being met. So the accounting will be done as per the further guidance given in 116, which talks about the fixed uh, component and variable component. It will be decided based on the guidance given in 116. Yeah. The third scenario was about the capitalization of internal development cost, because research and development is one of the key activity of pharma companies, and they spend a lot of money in the internal development costs. So it is important to understand the concepts like what can be capitalized and when it can be capitalized. So I've built a couple of scenarios around that. So in this scenario, there is a pharma company. Yeah. In this scenario, there is a pharma company which is developing a vaccine that has successfully completed phase one and phase two of clinical testing. The drug is now in the phase three of clinical testing. Management is still has significant concern about securing regulatory approvals, and it has not started manufacturing or marketing the vaccine. So the question is whether management should start capitalizing the development cost at this point. So there is very detailed guidance given in India's 38 para 57 about what kind of development cost can be capitalized and when it can be capitalized. So there are five criteria which have been given. One is about the technical feasibility of the cost. One is about the intention of the company to make it available. About the ability of the company. Ability will include all type of abilities, financial, and the technical ability, the future economic benefits which company is expecting from the development cost which is being incurred, and last but not the least is about the reliable measurement. If you can't measure, then it becomes very difficult to capitalize that cost. So generally, the obtaining regulatory approval is considered to be a very strong indication that entity has met all the criteria, as it is most difficult criteria to be met. So you have done everything, but it is subject to obtaining approvals from the government or from the regulators. Then you really can't say that it is highly probable that this will be successful. So in this case, because management still has significant concerns around securing the regulatory approvals, so it would not be appropriate for company to start capitalizing the development cost in this case. So you see, this requires the significant judgment by the management. So it is important for auditor to follow the guidance given in SA 540, wherein we are required to challenge the accounting estimates, look at the past trend, look at the basis based on which management has reached to a conclusion about their own judgment. And this has to be documented in a very robust way, because uh, like somebody should be able to re-perform what how did we test this estimate. So moving to the next scenario, again this relates to the capitalization of development cost. So in this scenario, there is a pharma entity which has obtained regulatory approvals for a new respiratory drug in one country, which is country X. It is now progressing through the additional development procedures and clinical trials necessary to gain approval in another country Y. And management believes that achieving regulatory approval in this secondary market is just a formality, which is perfunctory. And mutual recognition treaties and past experience between both the countries indicate that rarely the countries refuse the approvals obtained in each other's country. So in this case, the question is, can the development cost be capitalized? It is in spite of the fact that the company does not have regulatory approvals in country Y. So again, we spoke about the criteria given in India's 38 para 57. So I won't repeat those criteria. But the important point over here is that in spite of company not having the regulatory approval, company still believes that there is high probability that the company will get the approvals, and they believe that it is appropriate to capitalize the development cost, and it is backed by the past history and the treaties between both the countries. So again, as an auditor, we are required to challenge this judgment and look at the underlying evidences and supportings. We may even look at the treaties which management is referring to and what has happened in the past. Is there any precedence where country Y has rejected the approval in spite of there being the approval from country X? So we have to do our own independent procedures before relying on the management, and we have to comply with the requirement of SA 540 in this case. The answer is that yes, company can capitalize because the probability appears to be high in this case based on the treaties. The next scenario is where a pharma company is developing a generic version of a painkiller that has been sold in the market by another company for many years. The technical feasibility of asset has already been established because it is a generic version of a product that has already been approved, and its chemical equivalence has been demonstrated. The lawyers advising the entity do not anticipate that any significant difficulties will delay the process of obtaining commercial regulatory approvals. The scenario assumes that other conditions of para 57 which we spoke has been satisfied. So the question is, can management capitalize the development costs at this point? So here, the most important thing is the timing of capitalization, because the company does not have the approval, but there is high probability because this is a generic drug and it has been tested in the past by other companies. So there is no definitive starting point for capitalization. Management should use its judgment based on the facts and circumstances of each development project. So regulatory approval is deemed probable in this scenario. So management can start capitalizing internal development cost. It might still be appropriate to expense the cost if there are uncertainties about whether the product will commercially be successful. So again, you will see that there is a judgment involved by the management when they are looking. They are relying on the managed market, uh, like the generic version which has been tested in the market, sold in the market in the past for many years by other companies. So we will have to really see whether it is similar version, similar formula of the drug, and whether this it is relevant for in this case to rely on the past trend which company is using. And we have to follow the guidance given in SA 540 around this. Yeah. The next scenario is about the upfront payments made to conduct the research. So there is a pharmaceutical company, Astro, which has engaged the contractual research organization to perform the research activities for a period of 2 years in order to obtain know-how and try to discover a cure for AIDS. The CRO is well known in the industry for having modern facilities and good practices dedicated to the investigation. The CRO receives a non-refundable upfront payment of INR 3 million in order to carry out the research under the agreement. It will have to present a quarterly report. Astro has full right to access to all of the research performed, including control of the research undertaken on the potential cure of AIDS. The CRO has no right to use the results of the research. How should Astro account for the upfront payment made to third parties to conduct the research? While the initial view could be that it should be capitalized, but the expenditure on research should be expensed when as and when it is incurred. And for this, we have to refer to para 54 of India's 38, which gives further guidance around this. The payment is made for research activity to an external CRO. It does not meet the definition of intangible asset because company does not have any control on this, and it will not meet the other criteria of intangible asset, and it cannot be capitalized. Upfront payment is recognized as a prepayment in the income statement. However, it should be over the period of research activity. If that research activity is going to be there for 3 years, so that amount should be amortized over a period of 3 years because that is a periodic cost that company has incurred. So it should not be capitalized as a development cost in the balance sheet of the company. Yeah. This is very important because as I said, the pharma companies generally have a very significant balance in the intangibles, and they have a lot of IPRs and other know-how which they capitalize as intangible in their balance sheet. So, what are the indicators of impairment that management should consider? So, I have put down some of the indicators which are very specific to pharma entity, which one may consider while assessing whether there are any triggers for the impairment. One is development of a competing drug. Like if there is alternative drug available, it will have impact on the company's original plans. So that could be one of the trigger for company to assess the impairment. Changes in legal framework covering patent rights or license. This is very critical, and this may have direct impact on the feasibility of that product and may trigger impairment. Failure of the drug's efficacy after a mutation in the disease that it's supposed to react. So company would have assumed efficacy, and if it is not being maintained, that could trigger the impairment. Advances in the medicine or technology that affect the medical treatment, very relevant. Lower than predicted sales, the market is not picking up. Impact of adverse publicity over brand names. There could be some instances where there are some class suits or the drug has not performed in the expected manner, so it may affect the publicity of the brand. The changes in economic lives of the similar assets. There could be litigations which may also have impact on the impairment of the intangible asset. Relationship with other intangibles, there could be such kind of relationship which may have impact. Changes or anticipated changes in the participation rates or reimbursement policies of insurance companies, because this is very critical aspect. The insurance plays an important role in this whole sector. The Medicare and government for drugs and other medical products. So again, this is an indicative list. This is not an exhaustive list, but most of these are very specific to pharma companies, and the auditor should keep in mind these indicators in order to assess whether there are indicators for the impairment. So examples of development costs that can be capitalized and what cannot be capitalized. So a lab is developing a drug to cure SARS. Management has determined that it meets all the criteria given in para 57. Now their question is what kind of expenditure can be considered development cost in the pharma industry. While the general rule is that it should be a direct cost, like for example employee benefits for the personnel involved in the research activity, the overheads that are directly attributable to developing the asset, the allocation of the depreciation of property, plant, and equipment which was used to develop the drug, legal costs which have been incurred in presentation to authorities for that particular drug, design, construction, and testing of pre-production prototypes and models for that drug. So this is just again an indicative list of costs which can be considered as a development cost. But what cannot be considered as development cost is the expenditure such as training the sales force or performing market research. This will not meet the criteria because this is not relating directly to the development of that drug, and it does not create or produce or prepare the asset for its intended use. So again, the judgment is involved over here, and auditor is required to corroborate the audit evidences underlying, looking at the supporting documents whether it is directly relatable or not, and then decide. Yeah. Accounting for promotional campaigns and free samples. This is very relevant for the pharma companies and the most uh, talked about issue. So, in this scenario, a pharma company has developed a new drug that simplifies the long term treatment of a kidney disease. The company's commercial department has incurred significant cost with a promotional campaign, including TV commercials and presentations in conference and seminar for doctors. How should the above cost be accounted for? So again, initial, the view could be that this is directly relating to the drug, but the answer is that the company should not recognize its advertising and promotional cost as an intangible asset. Even though the expenditure incurred might provide future economic benefit, it should charge all promotional costs to the income statement as it does not meet the definition of intangible asset. So you cannot control that asset. Expenditure on advertising and promotional activities should be expensed when incurred. Similarly, free samples distributed to doctors should be recognized as marketing expense when the cost is incurred. That is, when the product is packaged as a sample product. Immediately, it should be charged to the income statement. Accounting for right to return. Most pharma companies have, as per their contractual terms, right to return. So this how should this be recognized in the financial statements? So entity shall recognize a refund liability if the entity receives consideration from a customer and expects to refund some or all of the consideration to the customer. This is given in para 55 of India's 115. So this will definitely involve the estimation because you don't know how much of this will come back. So company will have to do some trend analysis and look at the past data to develop an estimate of the refund liability, and this refund liability will have to be recognized in the balance sheet as a non-financial liability. It may be current, non-current based on the expected time of the outflow based on the past trend. So considering non-financial asset should be recognized, corresponding non-financial asset should also be recognized toward the expected value of inventory to be returned, because otherwise it would be one-sided transaction. So if we are recognizing the refund liability, company will also recognize the asset which it expect to be returned by the customers. So the net impact would be only the gross margin which company has earned, and there would be an asset and liability in the balance sheet which has to be recognized separately in asset and liabilities. So this will involve the estimate. So as auditor, we should look at the data used by the company and how this has happened in the other products or for the similar products in the past, and corroborate that independently. Yeah, this is a very similar example. I will just skip this. Very similar. Yeah. So revenue recognition for sale to customers with a history of long delayed payments. So, the example could be the institutional sales where companies selling to hospitals, where generally there is a delayed payment. So how should company recognize revenue to such customers? So the guidance is the revenue should be recognized only when it is probable that the entity will collect the consideration. This is the general guidance for any revenue. Slow payments necessarily does not on its own preclude revenue recognition. However, it might affect the amount of revenue that can be recognized. This is because the receivable will have to be discounted at the initial recognition if there is a significant financial component identified at the initial stage of transaction. So if the like even if in spite of the contractual terms, if the history indicates that there will be a long payment period, so it might require the company to discount the receivables, and it has to be done as per the standard. So if the entity concludes that it will receive an amount which is less than the invoiced amount by giving price concessions, it has to evaluate whether it granted an implicit price concession or whether the receivable is impaired. So again, this will require the sufficient and appropriate audit evidence as per SA 500, and this will also impact the ECL assessment of the company, expected credit loss. So this will be one important factor that company will have to consider in deriving the ECL number. Yeah. So these were some of the scenarios which I thought are important based on my experience of auditor pharma companies. And if there is any specific question that the members have, I'm happy to answer. Or out of any of these scenarios or any other accounting or auditing question, I will try to answer.
Sir, as of now, we have not received any questions from any of the members.
Okay. So there is one aspect which I actually didn't cover in my presentation was about the e-pharmacies, which is very, upcoming and new age business. So there are a lot of companies which are engaged in the e-pharmacy business, and this requires the careful consideration because there are different set of laws and regulations which are applicable to e-pharmacies. So I would urge members to familiarize themselves with the regulations which are applicable to e-pharmacies and make sure that we discharge the responsibilities which we are required to do as auditors.
Abhilasha, are you there?
Yes, Nishi, I'm here. If you have any question, then please put in message box. Sir, we will wait for some minutes.
Yeah,
Then
sure.
Sir, members have requested for the PPT.
Yeah, I will share it with you, Nishi, and you can share
Sure,
it
sir.
with whoever member requires it. I'll
Sure.
email it.
Abhilasha?
sir, we don't have received any question. I
Yeah.
think queries have been resolved.
No problem. So I will be around for some more time. If there are any questions, I will be able to answer later.
Okay, yes, sir. If you have any question, then you can put in message box. Then sir will answer this. So can we move forward for next session?
Sure.
Okay. So thank you so much, sir, for sharing your knowledge with us. We have also our next speaker, C. Nitin Parikh, sir, who will share the strategies for managing risk in pharma sector. Sir is having qualifications of CA, LLB, CFA, MBA from IIM Ahmedabad, and MBA in pharma sector from ICFAI University. Sir secured 5th rank in CA Inter and 21st rank in CA final in all over India. Sir is serving as a CFO in Zydus Life Sciences Limited and having more than 38 years of experience in financial, legal, and IT functions. Sir received the CA Business Leader Award, Excellence in Merger and Acquisition Award, Best CFO in Pharma Sector, and many more. Sir, I request you to please enlighten us by your profound knowledge.
Thank you. Thank you, Bilasa.
Yes, sir.
Good afternoon, all. And thank you for this opportunity from members in industry committee for being with you and talking about pharma sector related matters. So the risk management the strategy is the topic that I have taken. I would, Bilasa, share my presentation and then take the people. Are you able to see my presentation?
Yes, sir, it's showing.
Okay,
Sir, your PPT is visible.
thanks.
Yes, sir.
So the topic is strategies for managing risk in pharma businesses. I think pharma is amongst the most regulated industries. While all the industries have certain regulations, I think the width and breadth of the regulations which affect pharma are significant. The risk in pharma are again related to other industries significant because pharma deals with the lives of the people, and when you are dealing with the life, you need to be extra cautious in terms of all kinds of risk. With that background, let me take you first with the general framework of risk, and then come specific risk related to pharma. So, what is the purpose of risk management strategy? I'll just minimize this 1 second. So the number of economical, social, financial, political, cyber, and legal risk across the various industries have risen exponentially over the years, and the companies find themselves in search of various strategies to mitigate and manage the risk. There are certain common risks impacting the businesses in the pharma industry, which include risks related to competition, pricing, regulations, policies, patent expirations, political turmoil, fluctuating raw material prices, supply chain disruptions, and many more. And therefore, our risk management strategy helps companies approach that risk with the right kind of preparation, with actionable insights, and also comprehensive strategies. Organization, coordination, and proactive approach can significantly minimize the impact of major risk and mitigate minor risk. However, to gain the benefit of a risk management strategy, the strategy must be efficiently planned, implemented, and modified over time to meet the changing needs, expectations, and goals of the businesses. We'll talk about the various framework related aspects and the steps related to developing the risk management strategy. The first is identification, second is assessment, third is mitigation, fourth is monitoring, and fifth is reporting. And we'll discuss all these steps in subsequent slides. First, talking about identification of organization risk levels, identifying the risks themselves. So every organization is susceptible to plethora of risks, and these risks will be varying in terms of degrees, in terms of their severity, in terms of the longevity, means the period till which they continue. The overall impact, the impact can be both in terms of top line, bottom line, organization, its future ability, and many more, and ability to even address or mitigate the risk. So to ensure an accurate and effective solution, companies should make a collaborative and communicative effort to identify all potential risks which affect their businesses, whether the departments, any components, any systems, or maybe the entire value chain, starting with research, development, production, marketing, distribution, purchase, collections, all the whole chain of value part. Risk identification involves discussing potential risk with various stakeholders, your company people, your team managers, the employees, the partners. They're all called the risk owners. And compiling said risk into a comprehensive list, which is called a risk register. So risk register list all kinds of risks that the company is facing, and then obviously to work out the strategies for each of them. And risk management teams must factor environmental changes in terms of the changing laws and policies, fluctuations in demand and supply for the products of the company, the raw material prices, other external internal factors. It also assess their impact on the organization and the business. On the right side of many of the slides, you will find some cartoons which go along with this, the theme of that particular slide. So here you say what it will be, one large risk or several small risks. I think the point which I'm trying to drive here is that while every organization is faced with a several, number of risks, it's not possible to first of all consider an impact of that and mitigation of all of them. But it may still make sense to first list down all the risks and then to decide that some of them will be addressed, some of them will not be addressed, depending on the impact, depending on the priority, depending on the resources required for the mitigation part. The next stage comes is of assessment of identified risks. So assuming that now we have the risk register ready with us, we need to assess the impact of each of them. So once the research is ready, risk management teams must assess and evaluate each potential risk for the urgency, the impact, the likelihood, also the probability of that risk getting materialized, and the priority. And the priority of each risk, even within particular industry, let's say pharma, would be different. For example, a company which is dealing only with the Indian market versus a company which is dealing with the global markets, the impact, the probability of the risk will increase, because if you are dealing with a number of different health agencies, regulatory agencies, it obviously calls for higher magnitude of risk, higher probability of risk compared to one which is restricted to one particular market. Accurately prioritizing the risk according to severity of impact can help the company ensure that to take the most significant risk with the right strategies to minimize the probability of severity. And we'll discuss what kind of tools, techniques are available for these management techniques. This step also involves allocating the reasonable and commensurate resources at required times, thereby reducing the probability of major risk being ignored or allowing worsening over time. Many times, if you ignore the risk, the extent of the risk keeps increasing as the time passes. So ignorance of that or ignoring a particular risk is not a right strategy. And then developing a comprehensive matrix to determine various factors such as the likelihood and impact can be highly beneficial and can help the leaders collaborate throughout the risk management strategy development and implementation process. Typically, the way this is to be done is that you have the list of all the risks, let's say to Z. You decide the probability of each of them, you decide the impact of each of them, and then you can assign a particular score to ultimately decide the weighted average risk score for all the risks, and then decide the prioritization. Also decide the strategies for that. That's the very structured approach to risk management. So on the right side, you said a possible risk, the various risks. He certainly does a very thorough risk analysis. The idea is that, for example, 1422, 1423, 1424, if you go on identify risk at this level, it won't allow you to actually frame any strategy. So what are now the plans and techniques for risk mitigation? So as we said that, the magnitude of risk can be multiple, and therefore it makes sense to decide first the approach to that and then the strategy for that. So due to sheer large and diverse canvas of the multitude of risks, it can be highly challenging to evaluate, address, and mitigate all the challenges. So it's not possible, and neither one should attempt to address all the risks, irrespective of the impact part of that. However, with the efficient risk management strategy, identifying and evaluating the impact of risk is significantly easier. So mitigating every risk may not be possible or not even advisable, as I earlier mentioned. In certain cases, the main target is minimizing impact as opposed to mitigating it completely. The reason why I'm mentioning this is that mitigating the risk in totality or avoiding the risk in totality in certain cases is not possible. So the way to address this that is not to still ignore that we can't completely influence that, but there could be certain still the ways and means of minimizing the impact. During this step, addressing the high priority risk first is imperative, and then the team can gradually address every listed risk to the best of the organized ability, considering the cost benefit analysis. And in case reducing the likelihood of a risk is improbable, the company must develop a plan of action when an event takes place. What exactly will you do? How will you still minimize the impact at the time the event itself happens? Like we talk about business continuity plan, contingency plan, plan B, etc. These are also the ways of managing the risk if that event happens at all. This plan should also stipulate roles and responsibilities of different persons with a suitable monitoring mechanism. In a sense, there are 5 techniques of risk management or mitigation. First, which everybody would first like, is to avoid the risk. Now, in certain cases, it is still feasible. Well, in all the cases, you can't avoid all the risk. Certain risk can be avoided and see how. Second is the retention. You say, okay, I know the risk, I've identified. I'm okay with that. I don't want to make any specific attempts to reduce that. Third is the spreading part of that. You spread the risk or diversify the risk. Fourth is the loss prevention and reduction. And fifth is a transfer, means through insurance or other contracts. You transfer risk to somebody else. And let's discuss each one of them. First, avoidance. So many times it's not possible to completely avoid the risk, but the possibility should always be explored. For example, at the height of the thunderstorm, physical plant may not release any vehicles for travel until the weather begins to clear, thus avoiding the risk of auto accidents during the severe weather. For example, in Zydus, we have plants located in Batti, we have plants located in Sikkim. Now, Sikkim, during the monsoon season, many times there are landslides. So the way to address that risk is avoid traveling during that period, avoid movements during that period as far as possible. Take the another route which will be a little longer, rate may be higher, etc. Look at the refinery at Jamnagar for Reliance, whether Jamnagar is located near port, okay, and therefore there is a severe problem in terms of rising water levels, and which can affect, or a thunderstorm which can affect the refinery. So during that period, restricting the movements can help in terms of avoiding certain risks. Retention. As I said, likelihood of frequency and severity of the risk presented would always be there, but retaining a part or portion of the risk may be cost effective, even though there are other methods of handling the risk which are available. Example is that instead of taking annual maintenance contract of some machinery, if we procure some spare parts for this task or risk, we say all of a sudden machines should not get, if there is a breakdown, all of a sudden machines should not stop and production loss should not be there. And therefore we say, okay, let's have a AMC. The other is to find out which parts normally, create a problem and keep some buffer stock for that. Let's say the motors get, all of a sudden out of, power. You keep additional surplus motors to take care of that. The same companies consider self-insurance instead of taking, let's say, reps and warranties insurance. In merger and acquisitions, these days, especially in the Western, countries, it's very usual to have reps and warranties insurance rather than indemnities being given by the seller. Now, some companies can decide based on the expected liabilities which may arise later on. Buyer may decide not to go for reps and warranties insurance. Say, okay, I'm fine with this risk if they materialize because risks are well within the contained area, well within my boundary, and obviously they may not arise. So why should I pay the premium for that? That's the retention part of risk. So I retain the risk and don't want to pay for that. Third, which is a spreading part. It's possible to spread the risk of loss to property and persons. For example, different location of the manufacturing sites to assure availability of the products in case of problem arising in one site. For example, if you have more than one site which can produce the products, there is a problem, there is a lockdown, there is a fire, or any particular event which disrupts the production at one location. You say, okay, I can still produce that product at other location. This also happens, for spreading the regulatory risk, especially for developed markets, where you cannot, produce any product on any plant unless that's approved plant for that country. And also the product is approved by that country on that plant. So the way some companies handle this is that for major high value products, you do the filing of the products from two different plants. While you may continue to manufacture from one particular plant, which it makes sense in terms of the cost of production. In case of any risk, in case of any regulatory action on that particular plant, you can start producing the product at a different plant. And though obviously in the regulatory pathway, there's always possibility of site transfer, but it takes time. But if you already have approval for two different plants for the same product, you have spread that risk in that manner. Fourth is the loss prevention and reduction. So when risk cannot be avoided, the effect of loss can often be minimized in terms of the frequency severity. For example, the risk management encourages the use of security devices on certain audiovisual equipment to reduce the risk of theft. Where the person cannot just take away a particular item because there would be siren because of that. And there will be various kind of suitable softwares also to take care of this, including for the cyber risk. And the fifth strategy is a transfer part. So in some cases, risk can be transferred over, usually by contract or by insurance. Insurance, all of you are aware, you take the insurance for various kind of risk, fire, all risk policies. Some of the progressive companies also take a loss of profit policy or any business disruption. So where not only you get, if there is a fire, you obviously get, compensation and insurance amount for the loss which is incurred because of the assets. But you also get, if you have a loss of profit policy, loss which is arising because the plant is not in a position to produce the goods for a certain period. And during that period, based on your past and other track record and details that you can provide, you have lost the profit which you would otherwise made. That also can be considered with a loss of profit policy. Contracts. Often vendors and service providers will attempt through a contract to release themselves from all liability for their actions related to the contract. These are often referred to as the hold arms or indemnification clauses. Monitoring of the risk management strategy. So once the mitigation plan has been developed and implemented, the next crucial step is monitoring the effectiveness of the plan. The probability of occurrence of the identified risk events. Now, this step includes working closely with all the departments and stakeholders, tracking all significant metrics and evaluating the effectiveness of the implemented risk management strategy. It's important to monitor throughout the risk management process and take the active role in assessing and controlling all the relevant factors. During this step, all department leaders must remain engaged and communicative, and team must be encouraged to actively look for any incidents. This is the monitoring part, and therefore, the monitoring cannot be in one party. There has to be a mechanism, there may be technology, there may be software, there will be meetings, there may be steerco, risk management group, and obviously, the risk management, committee at the board level. All these in the entire format of monitoring mechanism has to be clearly put in place, understood, and implemented every time. And the risk management team should also reevaluate the priority and severity of the risk if the implemented risk management strategy was effective. As we initially talked that risk register, we will have the probability of risk and the impact of risk. Now those things are not static. What it means, if not more, every year, every 2 years, there is a need of revisiting the entire risk management framework, the list of the risk, their impact part, their probability part, everything needs to be again assessed. Looking at the various measures which the company would have taken in terms of reducing the probability of risk by softwares, by other applications, by technology. When you reassess that for the second time after implementing certain measures, hopefully the probability of certain risks should have gone down. That's also the purpose of keep on reevaluating this. Secondly, in terms of the impact part, the impact in a particular year when your own stakes in that particular product or segment or market was, let's say, 500 crore. After 2 years, it may be 1,000 crore, and therefore the impact also would be of a higher magnitude. So this is what it means is the entire risk management framework has to be very dynamic. It is not a static exercise. It's a dynamic exercise to be repeatedly done. Reporting of the risk management. So compiling, evaluating, and presenting all the relevant data, plans, and approaches implemented through risk management strategy help company assess the effectiveness of the strategy and also make necessary alteration in design of future strategy. Additionally, it helps provide stakeholders with relevant information regarding the major risks, steps taken, current status of potential current risk, and their impact on the business. And this step also enables the identification, capitalization, significant opportunities for improvement. There are long-term changes to be done, and it also gives crucial insights into the overall approach management resolution of risk. You find on the right-hand side in the cartoon, the risk management consultant submitted his report, basically says that we adopt a policy of risk aversion. Now, this is more in a lighter tone because risk aversion does not help. Now, from the general framework, let me now come to specific for Indian pharma companies. So the common risk identified by various Indian pharma companies, I have just first listed, and we are going to talk about each of them. Starting with the sectoral or regulatory compliance risk. Second is the competition risk. Third is the pricing risk. Fourth is delay or non-receipt of product approvals. Supply chain disruption risk. Success of critical projects or R&D or capital investment risk. Technology or information technology risk or cyber attack risk. Economic and geopolitical risk. And climate change and environment risks. So let me talk about each of these risks now. First, starting with the sectoral and regulatory compliance risk. For this, all slides related to pharma, I will be talking about with these three verticals of risk description, the impact, and the mitigation plan. So description of this is that failure to comply with the regulatory requirements because of tightening of the regulatory requirements by authorities across the globe, including India. What would mean in terms of the impact? Penal action or notice for compliance gaps issued by the regulators and the customers. And second is the loss of reputation and consequent threat to future operations. What is the mitigation plan? First are the policies for ensuring the quality of the products and the compliance with the rules and guidelines. As I mentioned, pharmaceutical industry is a highly regulated industry with SOPs, with frameworks, with country-wise requirements of regulations, standards, and various things. It's like do as directed, and whatever you do, keep writing what you are doing. So that way, it's a record-oriented industry. It's a regulation-related industry, and the regulations also keep changing every time. So the quality intelligence to keep pace with the ever-changing regulatory requirement. What it means that quality intelligence means that what has happened to some other companies, what has happened to some other plants. For example, there is a US FDA inspection at a plant of some other peer group company. So then Zydus team would also like to find out what were the observations given to that particular company in the plant, where the deficiencies were found, and then use that intelligence to also look internally and say that do we have any of these problems or we are okay. If we have problems, what are the ways and means of tackling the issues from our side. So that if you keep doing this for various companies, not only India but even globally, I think that will make organization ahead of the curve in terms of meeting the regulatory requirements. Third, effective data integrity governance to ensure regulatory compliance. Data integrity is supremely important for pharmaceutical industry, especially for the various regulated markets. And if the regulators find there are data integrity issues, means you tamper with the data, you're not maintaining correct data, or you destroyed the data which are relevant for the compliance, you can expect penal actions from the legal authorities, and those actions can be warning letter. It can go to the extent of even import alert, and those things obviously become very fatal for the growth of the business, and therefore the integrity governance is a very, very important part for pharmaceutical industry. And one way of achieving this also going for automation of various processes. And some of the points that softwares and other things that I've listed, like Lonjamoda, TrackWise, Documentum, Veritor, these are various kind of softwares and tools which help in terms of automation of various processes. The idea is that to the extent your manual processes, people are like expected to make mistakes somewhere. People are likely to somewhere deviate for no reason, but that's the way the humans work. And therefore, one way of handling this is that put the systems. Don't rely on people, rely on the processes. And the way of achieving this is through automation. And also keep yourself up to date every time by audit and compliance. There's independent periodic audits and CGMP compliance checks carried out to ensure that all-time audit readiness. That's what is the slogan in pharma. So we are 24/7 ready for any kind of an audit to come. So as a part of this exercise, the deviation investigations are done, process investigations are done, process validations are done, qualifications are done, change of control and trend analysis. All these things are done as a way of life to ensure that regulatory compliance is at its expected levels. Competition risk. Description is the presence of a large number of players in the generic space results in increased competition, which in turn brings the prices down. And second, intensification of competition and threats of new entrants in existing key markets and therapies impede companies' ability to drive improvements in the market share. The negative impact of this is on profitability and rendering some products unviable at times. What can be the mitigation plan for this is to focus on developing special products, high niche products, high value products, limited competition products. That's the way to handle the competition. Also identify the complex generics and products sold through specialty channels. Establish relationship with the specialty distributors. This is the way to create niche segments, which obviously are less competitive than the general segments. Increase the penetration within the existing geographies and enter into newer geographies. For example, some of the new generation companies which came in last 10-20 years, and some of them now become very big in Indian pharma. They started with tier 2, tier 3 cities. They say all large players are already there in the big metros and major towns, and therefore the focus of major companies is in major towns and cities and not in villages. Some companies started that let me start playing at villages. Now, obviously, those companies have also become big and they also are now in cities. But the important point is the way of handling this competition risk is to find the pocket geographies, therapy areas where you find less penetration of your competitors. Launch of products in the focus therapy areas, including the line extensions. So every company would have some therapy areas. This is more true for India and other branded formulation market, where you are strong. So some companies are strong in cardiovascular, some companies are very strong in respiratory, some companies are very strong in oncological products, some companies are strong in ortho products, and so on. So because it means going to doctors, having your people understanding your products, going to a set of doctors in specific areas, where because of your range of products in one particular therapy area, you can say, I have everything which anybody can offer in this particular therapy area. That itself becomes a differentiator so far the competition is concerned. And next is the expand the presence in hospitals, institutional channels, modern trade, e-commerce business. With the competition increasing, people are trying to find out ways and means of making their products available through different routes, including e-commerce routes, institutional channels, modern trade. People participate now. Some of the people were not participating in tenders, including state government tenders, central government tenders, other countries' tenders in emerging markets and elsewhere. Now, people have also started looking at these as measures to mitigate competition risk. Pricing risk. Governments of some countries regulate the prices of medicines and periodically revise them downwards to make them affordable to the patients. This is in many countries, including India. In India, we have National Pharmaceutical Pricing Authority called NPPA, which under drug price control orders and various other regulations keep coming out with notifications for fixing the prices, obviously lower prices. And till this time, I think most of the life-saving drugs are covered under that. So that's the risk which a company already has. And this is true for many other countries also. In other countries also, they periodically, the health ministries revise the prices down. So what is the impact of this? The company's revenues and profits get adversely impacted in the event of adverse pricing regulations for key products. On the other side, I must also mention that there is a method or formula under which the prices can be increased. For example, in India, for all the scheduled products, they come out with a wholesale price index. Based on that, the prices can be increased. And for rest of the products which are not part of the scheduled products, you can increase the price on year-on-year basis to 10%. That obviously doesn't mean that every company for every product will be in a position to increase by 10%, because it's also the regulatory part in terms of competitive landscape that you have to look, your market share, market position, the peer strategies, many things actually determine that how much price increase one can actually take. The mitigation plan is a review of every country's specific price regulation laws to ensure that we take potential impacts into consideration when making a pricing decisions or therapy decisions. Driving volume growth for products with competitive cost advantage. Now, for every product, you may not be competitive in terms of the pricing, but similarly for the cost of products. But somewhere, because of the economy of scale, you may have the kind of machineries that you may have. For certain large volume products, your cost of production may be very low. So you can use that as a one way of trying to get a better market share by passing over that cost advantage in terms of your prices, and in the process getting larger volume of business. Third, the continuous cost optimization initiatives across the value chain and across all the cost components under various programs. For example, Zydus, we have a program called Prism, Slim, Zero Based. So under Prism, we look at all the various cost components, whether they're the material cost, manufacturing cost, indirect factory, indirect cost, admin cost, sales and distribution cost. Slim is a short form of strategic lean integrated manufacturing, where all the processes of manufacturing are looked at in terms of the wastages, yield, etc. Input output norms are revisited. Packing material, almost everything is revisited. Zero base is the project that we implemented last year in our India business, which states that you start with the zero and redefine why any cost is to be incurred at all. I think it's a very different and difficult way of looking at the cost, but very powerful way of zero-based budgeting. Next is to identify and conclude deals with customers where volumes are very high, thereby ensuring strong market share. So if you already contracted large volume of your capacity to specific buyer with specific prices for large volumes, that obviously itself will give you good cushion in terms of meeting the pricing risk. Next risk is a delay in or non-receipt of product approvals. So the regulatory authorities in the respective countries need to give product approvals for launch of the products. The regulatory bar and requirements keep changing, actually keep increasing. What is the impact of this? The impact is delay in product approval means loss of market share in the respective product or market segment. For whichever country and for whichever product, you don't get the product approval, you can't launch that product. So that is the one impact. But that's in terms of delay. The non-receipt of product approval actually is of higher level of cost, because not only we lose the business opportunity, but whatever cost we have incurred in terms of the development, filing, and registration of product, it also goes west. So the mitigation plan for this, which many companies follow, is to improve the quality of dossiers by stage gate review. When you file the product, called a product dossier or UNDAP for formulation, when you file that, you ensure that all the requirements of the concerned health ministry are adequately factored in, considered and complied with, so that the chances of delay, the delay normally happens because there are some questions. There are observations given by the authority to comply, and unless they satisfactorily get answer to that, they will not approve the product. So therefore, if you do right work from the beginning, then the time to get the approval obviously will be more controlled. Second is a speedy response to the deficiencies. Deficiency means when the health ministry writes you a letter asking certain more information for the products that you have filed, how fast you are able to respond to that. If there is a letter which is received and then you take months together to respond, that obviously you can't expect the approval to come before satisfactory answers are provided and also accepted by the authorities. So the quality response based on the learnings from the deficiency trends to reduce the review cycle and faster approval. Most of the organizations are in existence for several years, and for various products that one has filed in a particular market for all these years, you would have received many such comments in the past. What's the learning of that? How are we utilizing that learning as a training to ensure that at least the same kind of mistakes are not repeated, the same kind of deficiency observations are not received? That's a training part for the entire organization. And what happens in every organization, because of the attrition of people, the people who are trained may leave the organization and new people would have joined. What it means for the organization is that training schedule has to be every year to cover all the people to a particular level of understanding. So proper communication with and clearance from the regulatory authorities on dossier filing pathways prior to submission. When we want to file a very, very important product, where the development cost is also very high, where there can be little ambiguity in terms of the regulatory pathway or the clearance, typically we have meeting with the concerned regulatory authorities in whichever market, whether it's a US market or Brazil market or France market or whatever market. We hold meetings with them and we ask them specific questions and say, this is what we interpret. Is this the right interpretation or your different way of looking at things? So that we are not taken by surprise. So we take that guidance into our understanding first and work out our product filing strategy accordingly, so that the chances of we getting unpleasant surprise later on, we can avoid them. Supply chain disruption risk. The description says a rising cost of raw materials, utilities, and logistics, impacting margins and profitability. And second, disruptions in supply chain due to geopolitical and socio-economic threats and macroeconomic developments. What is the impact? Significant impact on the profitability on account of increasing raw materials cost, utility cost, logistic cost, and inability to consistently service the demand of customers across the globe. Many pharma companies during COVID time observed supply chain risks where the freight cost had significantly gone up. Sometimes, if I talk of, let's say, US, depending on the volume, it becomes double or triple than the cost which were earlier there. So huge cost. Some of the APIs cost were significantly high during that period. And many companies, including India, started from thinking that at least for life-saving drugs, they would like to be self-reliant, no matter what it does mean in terms of the cost. So the impact, inability to consistently service the demand of customers across the globe. What is the mitigation plan? Identifying key APIs, that's active pharmaceutical ingredients, which is the bulk raw material for pharmaceuticals, excipients, and other inputs, and continuous monitoring of pricing trends to take appropriate buying decisions to protect against the increase in cost. Identifying alternative vendors for key raw materials and developing India-based vendors to have better control on the cost, quality, and supply. If you are dependent on one supplier only, then there's a problem. Now, typically what it happens in pharmaceutical industry for regulated markets, your raw materials also has to be from the approved source. So it's not that today you buy from A and tomorrow you can start buying from B. It's not possible. The other B side also has to have that approval from the same authority for the same product or same API. And therefore, this is a process which cannot be done overnight. As a part of strategy, large companies as us identify major items, major APIs where you would like to have alternative vendors so that you're not dependent on one only. Now, depend on one means two different implications. One, you don't have pricing negotiation power because you are dependent on one only. And secondly, if something happens at their side in terms of any regulatory action, you're just out of the market because you can't get that raw material from anybody else, which is not approved source. And therefore, your own marketing of those products would come to a grinding halt. That's also a reason why alternative vendors are required. Now there is a China plus one strategy, and many companies have started utilizing production link incentive scheme, PLI scheme for pharma, which is already there for formulations. It's also there for API, excipients, key starting materials, etc. That's also one way of preparing it. And what the government wants is developing vendors based in India to better control cost, quality, and give thrust to Make in India movement. Next is the success of critical projects or large R&D programs and including capital investment programs. Risk description is non-achievement or significant delay in achievement of objectives of large inorganic opportunities, R&D programs, and capital projects. The impact can be significant on profitability and return on investments. What are the mitigation measures? First, ensuring realistic approach to valuation, critical evaluation, and due diligence of each and every aspect related to the project. So this relates to the M&A part. So when you go for any acquisition, don't go on a very, very optimistic note. Be very realistic. Prepare a base case scenario, pessimistic scenario, optimistic scenario. Take a very balanced approach. Do the proper sensitivity analysis. As a pharma company, we keep evaluating several targets at any point of time. I've been part of more than 20 different M&A deals of Zydus. And what we have learned over a period of time is to become disciplined in that approach. And there are evaluation matrices which are to be kept. For example, and this is more of a suggestive framework that if it is a capex program, you will have high years payback period. If it is a debottlenecking operations, it should have 3 years payback period. If it's just a cost reduction project, it should be 2 years payback period. Something like this, as a matrix you should have. This is also to ensure that you don't run the risk which is beyond your bounds. Especially for M&A, you should also decide go or no go strategy. That okay, it meets this A, B, C, D criteria, then you go. It does not mean 1, 2, 3, 4, don't go. So this is important. Now, to one way of handling this is also through putting the various financial parameters, certain strategic boundaries. It's important for organizations not only to have the list of do's or where you will do M&As, but also to have a list of deals where you say I will not go for M&A. I think from both the ways we can make this system robust and in the process reduce or mitigate the risk part. And a periodic monitoring on implementation of key strategies plan and achievement of key milestone versus a plan, whether this is a capex, whether it's M&A. For example, in M&A, before the acquisition, a company would have prepared its own, let's say, 5 years projections, including its profitability, gross margin, cost, net margin, etc. Now, once the acquisition is completed, one should keep on comparing the original projections versus the actuals and say where we went wrong, if at all we have gone wrong, or where we are better, compared to our own conservative estimate, we are doing better, where we are doing bad. Both the ways the learning takes place. And one of, and this very, very powerful, point that I have made, the last point, which to reduce the risk, is establishing the discipline on investment in debt raising. For example, your own funds and you have a debt funds. right? But if you put the limit that my debt, for example, my net debt to EBITDA would not go beyond 3:1. That means my maximum debt can be 3 times my EBITDA, right? Now that's one limiting factor which will not allow you to take the risk beyond that limit, even if it's M&A or it's capex, right? And also in terms of debt raising, you say that one is this financial parameter, second is you say debt to equity, you put a limit, you say maximum amount of absolute value of the debt, I will not go beyond this, and things like that. Now these are all the measures which allow you to have a proper discipline in terms of your reducing the risk of large projects and M&As. Technology information or cyber risk. Disruption of companies' operations caused by cyber security breach or digital infrastructure, which is financial, operational, and reputation loss. That's the risk description. What are the mitigation measures? One is to strengthen the cyber security controls, to undertake initiatives to lower operational and strategic risk profile, and take swift actions on emergence of risk across the businesses. There are plugin to report phishing emails. There are softwares available. Where any phishing email comes, automatically that will be blocked and reported. There is an early detection response measure called ADR. There are artificial intelligence based various threat detection and remedial tools available. Obviously, each has its own cost. No particular tool can give you guarantee, 100% guarantee that no attack will happen. It's like more the merrier. Whatever you spend, nothing is enough. But you have to keep on increasing your investments in mitigating this way. This is a very, very important, risk which is now emerging. Many of the pharma companies during the COVID time also, had this risk, and there were rumors going on that some of the pharma companies are going to go attack. But what I also found that some form of risk, most companies also observe. One also mitigation measure is replacing all non-GXP systems. Your let's say Microsoft, which is version 7, version 10, etc., etc. Some of they are not supported by currently available modern tools because they don't run on them, and therefore this is also investment which is unavoidable kind of investments. Some of you would have learned this, which Sun Pharma had already given intimation of the stock exchange. This was in 26 March 2023 only, where there's update given on the IT security incident. The IT security incident happened with Sun Pharma, and this had relatively compared to many other businesses, little large impact. It took many number of days for them to come back to the system. So this risk is a real risk and not a theoretical one, and therefore a lot of attention is required to be given to cybersecurity. Economic and geopolitical risk. Description is a frequent political changes, including civil unrest and war-like situation in different geographies impact the economic activities in these regions. Significant uncertainty in companies' operations in regions impacted by political instability. Mitigation plan is to continuously evaluate political and economic scenarios across the globe and to cap the exposure to the affected regions. What it means to cap the exposure means, let's say in a particular country, example Peru, Argentina, or some other countries, right? Where typically you find forex issues, you find political instability, etc. You say, I don't want to increase my business in that particular country beyond a certain number. You restrict it, cap it. Even if there are larger orders, larger sales possibilities, you say, okay, I want to cut my risk. I don't want to take beyond this. And second is the securing receivables through letter of credit or advance payment. So if you are selling to a distributor or dealer in those countries where you find the risk high, you say, I would only work with LC for advance payments. Though it means, giving more margin or more commission to the distributor, that's okay. The return of capital is sometimes very important compared to return on capital. So that's the risk, we can handle by this kind of strategies. Climate change and environment risk. Ineffective management of greenhouse gas emissions, water uses may expose the company to climate, physical, and transmission risk, which might lead to disruption of operations and affect the business continuity. The impact can be negative impact on the environment and Mother Earth. Also, it can have impact on the company itself in terms of any regulatory actions taken. For example, the Pollution Control Board gives you a notice that your plant has to be shut down. What will happen? Think about that also. So mitigation plan is adopting new technologies, unlock the opportunities for more efficient manufacturing process and will also contribute towards business resilience. A few slides which are more in terms of the cartoons. The essentials of risk management. First, don't do anything wrong today. Two, don't do anything wrong tomorrow. And third is repeat. Is another cartoon. It says it's simple. First, we look at the upside, then we look at the downside, then we look at the upside, downside. And the last one, as requested, I did a risk management assessment. I concluded that there was no risk of any management. Do you have anything to do? I'll get back to you. Thank you. So that was from my side on various strategies for risk management in pharma industries. Any kind of questions for anybody, most welcome.
Sir, we have a question from Urvi Juneja. Can you guide career for CA in law and pharma field?
Well, CA is obviously a very, very noble profession, very interesting profession, gives a lot of opportunities for either in corporates or in practice, and doing various kinds of, consulting assignments, starting with, equity research to merchant banking, to investment banking, to private equity, to venture capital, manufacturing, bricks and mortar companies like us, startups. There's a huge opportunity available for chartered accountants. But law, let me tell you that this combination of CA with law is a very interesting combination. Like companies like us, for example, I just mentioned that, handling various M&A deals. M&A deals, apart from, financial due diligence and DCF and value, etc., also have very important part of agreements. And when it comes to agreements, how do you protect yourself? What kind of, reps and warranties you take? What kind of indemnities you ensure? Where do you, settle for the arbitration, jurisdiction? What do you mean by material adverse effect? Right? What do you mean by business in the ordinary course after, between signing and closing? Right? Now, these are all the terms, people would have heard, right? But if you are a lawyer, if you're law background, and when I say law background, I don't say that you just get a degree. If you really understand, law very well, then you can certainly make a very important contribution to your company, that you have finance and law both. In fact, that is maybe one of the reasons why in Zydus, I have both finance and legal, as my departments. One of the reasons for that is also my legal background and my inclination for law. In fact, sometimes, I, right time, I say, if I had a choice to rewind my career and decide, which profession I would have taken, in spite of being chartered accountant, some people have, chosen law as a profession. We have many such people, available in India. And in Ahmedabad, for example, we have Saurabh Soparkar is one prominent lawyer. He's a chartered accountant. He's a rank-order chartered accountant, but he's practicing on law. It's a matter of, one's own liking. But I would certainly say that CA plus law is a very important combination. I had fortunately CA plus law. I have done MBA from Ahmedabad also, and I have done CFA also. So that actually gives me a lot of respect and age over many other CFOs in the country.
Thank you, sir. Our next question with Nitin Khatri, sir. Sir, are you audible?
Yes, Abhilasha, I can hear you.
Okay. Sir, we have question from Devki Nandan Jindal. Can you elaborate on stock expiry of drugs and what evidence and accounting treatment to be followed in such cases?
Yeah. So, companies mostly have the policy where, like few months before the expiry of stock, they identify that stock using some systems and they make provision for that. So near expiry, like, is one of the area where they identify and make provision. And any expired product anyway has no value and has to be written off from the inventory. So it's a very standard practice that companies follow, and I've seen that companies
Yes.
are very uh, pro in doing this. They don't generally this area we don't find any adjustments because it is very critical for them to identify and be upfront on this particular aspect. Does that answer your question?
Yes, sir.
Just to add to what Mr. Khatri mentioned, typically most of the medicines would have 24 months to 36 months kind of, shelf life. And depending on the past trends, the companies make, these provisions for the expiry provision is made in the books of accounts, keeping in mind this period and the past trends.
Okay, if you have other questions, then you can write us in chat box. We will wait for 3 to 4 minutes. We are not receiving more questions. So should we conclude, sir?
Yes, yes.
Okay, sir. Thank you, Nitin Parikh, sir, and CA Nitin Khatri, sir. I, on behalf of ICI, thankful to you for giving your precious time and sharing your knowledge on pharma sector and stat audit. And I would like to thank CA Rohit Rovatia, sir. Sir, I think one more questions. Okay, no. Okay, and I would like to thank CA Rohit Rovatia, sir, and CA Durgesh Kumar Kabra, sir, for such a grateful session, and thank you to all the committee members, all the council members. And I would like to thank all the viewers and participants who joined us and kept their support till the end. Thank you so much.
Thank you. Bye bye.
Thank you so
Thanks.
much for the opportunity. Bye.
Thank you. Bye bye.